welcome to our joined up episode this week of Bondcast and Currency Exchange. For obvious reasons, we felt like the topics that we would be discussing across both would be very relevant for both audiences. So you have me, Imogen Bachra, as your host today on both channels. And I'm very happy to be joined by Brian Daingerfield, who is our head of G10FX in the US. And he has, as I'm sure you'll all be familiar with by now, led a lot of our US election strategy. We are recording this at the end of what feels, well, it's only been 2 very busy weeks, but it feels like a lot longer. So if we sound, and also for anyone watching, if we look a little bit tired, it's because we are, but it's given us plenty to talk about. So let's start with the election, Brian. That was clearly the most important event this week. A very decisive victory in the end, which sort of went against what a lot of the polls had been telling us, that it would be a much closer call than it was. What are your key takeaways from that outcome?
Hi, Imogen. Thanks very much for having me. So I think the big takeaway here is, a lot of people will notice that turnout looks like in the end it'll end up being a bit lower. And as it stands right now, we actually don't know for sure that Republicans won the House majority, which would be enough to complete the red sweep into government, with Republicans holding all 3, President, House, and Senate. But it looks quite likely that that's going to be the case. So, we can't say it fully definitively, but we could say it with, I think, pretty firmly, is that this was a mandate win. This was a mandate defining election win for former President Trump. So, this wasn't, he just barely squeaked by winning one electoral college vote, for example. This wasn't obviously an example of Democratic voters maybe voting for third parties and that helping boost Trump just barely, which could in theory have been, you could make that argument about 2016 when he won in a surprise. This was an election that, former President Trump won against, with a lot sort of running against him, right? And so this, I think, when we think about what the actual result means in terms of what it means for delivered policy, what could it mean for Trump's agenda? Remember, in 2016, one of the big questions was, will we get the full slate of what Trump was promising, or are moderating voices within his party going to try and pull him back to something that would be maybe a bit closer to the establishment Republican? I think by winning this election the way he did, and by pulling a lot of Republicans down ballot who were not polling as close as the presidential race was to victories. You think about some of the Senate races and some of the key battlegrounds in the upper Midwest, for example. I think Trump is not only going to win with majorities, most likely, but those majorities are more likely to be, moving in Trump's direction rather than necessarily trying to moderate him, because I think the voters gave Trump a mandate to make significant changes to economic policy. I think the postmortem on this election will be that, just like in a lot of countries across the world, that voters were very frustrated with high inflation. And even though the unemployment rate in the US is very low, and we spend a lot of time on these podcasts talking about how the US economy from a growth side has been really resilient, surprisingly resilient, in the face of things like increased monetary policy tightening, for example. The average Americans just doesn't feel it, right? Because inflation has been too high. And voters voted in Trump to make significant economic changes. And I think, with the majorities he has, the fact that he won in such a definitive way, I think one of the takeaways we will see is that the Republican Party is more likely to give Trump even greater leash to enact those policies and not really try and lean against him, because, I think that's what the voters were telling both parties was they want change, they want something different, and they want Trump to deliver it. And I think, relative to where we were at the beginning of this week, if you told me that Trump had won barely, we may have been on this podcast talking about how there may be some moderating voices and it might be difficult to work with what's likely to be extremely narrow majorities. Now I feel a bit more comfortable saying that I think those majorities will be actively working with Trump, because I think the voters gave him a mandate to make significant changes.
I want to come back to those policy points, but before I do that, perhaps we can just touch quickly on the market reaction. I mean, the sort of reaction through the night and into the European Open and all throughout Wednesday was pretty much as we had expected. Those kind of Trump trades that we talked about so much heading into the election, in terms of a stronger dollar, higher US rates, a steeper US rate curve. I mean, they all played out pretty much as expected. Is that fair, or you were looking for something different or expecting something different in the days and weeks to follow?
No, that is exactly right. I mean, that was, I think, the market's consensus sort of playbook, if you will, for the Trump sweep scenario, which in the minds of most was either the most likely or the second most likely. You're probably most people were about 50-50, ourselves included. That if Trump were to win, it would be more likely with a sweep, which is what we got. If Harris won, it'd be more likely with divided government. Obviously, that's a scenario we can push to the side. But stronger dollar, higher yields, both in the long end and in the front end, but specifically bear steeper curves, and in higher equities as well. We're sort of part of what I would call the tradition, the classic like Trump win playbook. And at least on the night of, all of that played out. Now, in some cases, you've seen in the last couple of sessions some pulling back of that. Now, to be fair, I think when you look at betting markets, that betting markets had been assuming that Trump was going to win. And so you could argue that some of this win was priced in. I would say that this win was more decisive than most would have believed. Certainly myself personally, that this was a more decisive win than I certainly expected. So you could say that some of the Trump victory scenario was already in the price. And as a result, maybe that blunts a bit of the move, or maybe allows the market to say, this whole buy the rumor, sell the fact kind of idea that you say, okay, Trump has come in. Now markets had been building up to that. Certainly we've seen rates rising over the past month and a half, dollar stronger over the past month and a half coming into this event. And now the event is behind us. There's certainly some of that to play out still. But I still think that when we think about the more medium term, what does Trump's victory with united government mean? And I think a lot of the reasons why that playbook makes a lot of sense still. So when you think about interest rates in the front end of the interest rate curve, because we're thinking about additional fiscal stimulus and the possibility of tariff increases that could increase inflation expectations, we think it's right that the market should be paring back their expectations in terms of how much Federal Reserve easing can be delivered and how quickly it can be delivered. And I think Powell was maybe lightly alluding to that at yesterday's FOMC, and I'm sure we'll touch on that a bit later in more detail. But we think it's right that we've seen a pare back of expectations, and we ourselves have also reduced our expectations. NatWest Economics have also reduced expectations for what the Fed is likely to deliver in terms of easing next year. So in the front end of the interest rate curve, higher interest rates as the markets reassess growth expectations thanks to fiscal stimulus and the potential for higher inflation expectations, that means a less aggressive and less preemptive, more cautious Fed easing cycle. So higher interest rates in the front end, and that tends to correlate with a better outlook for the dollar. So if before Trump's win, there was maybe a case to be made for the Fed moving more aggressively, being at the forefront of the easing cycle globally rather than more cautious, now I feel like you have to temper those expectations. And of course, in the long end of the interest rate curve, you're thinking about the possibility of significant deficit funded fiscal stimulus, where at a minimum, extending the existing Trump Tax Cuts and Jobs Act, the sunsetting provisions of that act that start to sunset out in 2025, at a minimum, some estimates say that alone could be worth $5 trillion in additional deficits over a 10-year horizon. But that's just extending existing law, not even considering additional tax cuts that Trump has pledged. And Trump has, he's been on the campaign trail pledging a lot of different potential tax cuts, things like removing the cap on SALT deductions, which was a revenue raiser in the prior TCJA, for example, removing taxes, exempting taxes on Social Security benefits, removing taxes on tipped wages. There's a lot of different, and even cutting the corporate tax rate, again, from its current 21% level down to as low as 15% for domestic production. So there is a lot of potential stimulus going out the door and effectively no revenue offsets. And so we think it's right that long end yields have seen, significant resetting higher here. From a sequencing perspective, we have to, there's a lot of uncertainty as to when all of this hits and how much of it actually comes through. But we think it's right that markets have to have reset higher yields here. And with it, the dollar has strengthened.
I think you're right when when we think about the market reaction, that's really being driven by the market's perception of what former President Trump might do with respect to fiscal policy and on the tariff front. We obviously well, I'm recording this in London, so it's a bit of a different setup here for us, where in the UK, you have an election and the prime minister becomes the new prime minister the next day. We obviously have this period now where we know that Trump is going to be the president, but he isn't yet the president. And there's a lot of uncertainty, I guess, around the timing of specific policies and what is going to be his priority. When do you think we can expect movement on the kind of tariff front and the fiscal policy front?
So let's start with tariffs. Tariffs could come into effect very, very quickly. And that's because Trump does not need any additional congressional approval to do what he wants to do on tariffs. There are a lot of previous laws that have been passed that by Congress already that give the president a lot of leeway on trade policy because, the president is, a very important figure in foreign policy, international relations, and trade policy sort of is almost a bridge between fiscal policy and international relations. It kind of spans those two. And because the president and the State Department spend a lot of time negotiating with foreign governments, Congress, I think rightly in a lot of these cases, gives the president a lot of authority on trade policy, even though, things like spending and trade are ultimately go back to Congress in terms of power of the purse, right? It does sit with Congress. So Congress has already given the president, any president, significant leeway to introduce new tariffs and trade restrictions. And Trump could use those very, very quickly. In fact, a lot of the architecture underneath the original Trump trade wars from his first term are still in place. They're still active and they can still be used at any time. In fact, the Biden administration used the Section 301 tariff authority that was originally justified under the Trump era. That's still active, and Biden used it as recently as this year in terms of increasing tariffs on certain Chinese goods. So, just a reminder that a lot of this infrastructure is already there and can be used very quickly. So in terms of the tariff push, especially against China, we feel pretty confident that we're talking about a first 100 days style event, that Trump comes in the middle of January and you're talking about tariffs extremely quickly. I think it's very clear that voters gave Trump a mandate to pursue these policies that he was pledging. There's obviously a difference between, when you're on the campaign trail, and this is true of all politicians, but especially Trump, when you're on the campaign trail, you're saying one thing, and then the reality is you come back into, when you get into power, maybe there's a change in how the implementation, actually works, right? There's, I call this a bluster premium, that there's an extra bit of bluster on top of the rhetoric when you're thinking about when you're on the campaign trail. So there's uncertainty about the levels of tariff increases, how much they'd be increased, but we should be thinking about that as a very early part of the Trump term. Think about, end of the first quarter into the second quarter is when you could see that come through. Trump and his party obviously are very keen on cutting taxes further and extending the expiring provisions of the Trump Tax Cuts and Jobs Act. But unlike the tariff authority, which is basically already there, it will take time to write another massive tax bill. It will take time to do what is going to be necessary to avoid a Senate filibuster by working through the mechanics of what we call budget reconciliation, which is the loophole through which basically every major law in American politics in the modern era is passed. The Inflation Reduction Act under Biden passed under reconciliation. The original Tax Cuts and Jobs Act passed under reconciliation. If you remember, it takes time to go through this process. Even in Trump's first term, when the first order business was trying to repeal and replace Obamacare, that bill was still effectively in committee in the summer of 2017. So Trump comes in January of 17. By the summer, that's when you have John McCain's famous thumbs down in the Senate that effectively kills the ACA replacement. But that took 6 months from start to implementation. If we put taxes on that same timeline, then you're talking about still a couple of months into the term before you can realistically get movement, I think. So from a sequencing perspective, I think for growth, this really does matter, which is that tariffs, which are, I think, the risk to growth is much more clearly to the downside, not just for the global growth for people who send us goods, but for us as well here in the US. There's clear risks to trying to push price increases onto an already price-sensitive consumer. Those risks to growth could come sooner than any offsetting or maybe growth positive changes to the tax code. And so I think investors should be thinking about that as thinking about this sequencing as we head into 2025 and thinking about when Trump can deliver on some of these priorities.
If you didn't already have enough on your plate this week and you already didn't feel like you were lacking sleep and couldn't find a moment to breathe, of course, we rounded out the week with not just the Fed, but other major central banks making decisions yesterday. But let's stick with the Fed for now. They cut rates, which was very much as expected, regardless really of what the election outcome was. Do you think that it played a role, that election outcome played a role into the Fed's near-term thinking? And how might it play a role, I guess, in December and beyond?
It's interesting because it's pretty clear that the Powell, especially at his press conference, tried really hard to make it clear that the election and the specifics of the politics don't play a role in how the Fed is thinking. And of course, he was very clear that he would not resign if Trump asked him to, and that it was his firm opinion and belief, and ours as well, that firing him, removing him, making an effort to remove him would be illegal under the current law, right? So those things Powell stood up and made extremely clear at his press conference. In terms of the decision that we got from the Fed, it seemed pretty clear that the Fed was on pace to cut the policy rate by 25 basis points, and they did so with relatively little fanfare. And frankly, the message from the Fed about this being a recalibration of policy and every meeting being data dependent and not wanting to pre-commit to any particular speed or scope of policy easing, if those are the hallmarks of the Fed, of Fed communication right now, all of those stayed in place. That being said, we did notice what we considered a slight lean in the hawkish direction from Powell, maybe a bit more open to the idea of potentially pausing in December. Now, that's not our expectation. We think the Fed will deliver a 25 basis point rate cut in December. But we got the sense maybe that on the margin, Powell perhaps a bit more open to the idea of pausing than maybe he was at the September meeting when he was being asked about the November meeting. And now politics almost certainly plays a role in that, because Powell, he did acknowledge that if any politician, if any government of any party makes changes to policy that have relevant implications for inflation and the unemployment rate, which are the Fed's dual mandate objectives, then that has to have an input into monetary policy. Although the Fed doesn't assume that. This Fed, frankly, has a really hard time looking ahead any more than a couple of weeks, any couple of data cycles, right? The next non-farm payroll report is going to tell us as much about the December meeting as any changes in fiscal policy that might or might not be coming in 6 or 9 months from now, right? So, Powell's in a difficult spot as regards fiscal policy because he has to balance how markets react today against the fact that we're probably not going to get anything meaningful on fiscal at a minimum until Trump comes into office in January, let alone the potential delays in actually getting stuff out the door, right? And so we got a sense that Powell was maybe a bit more open to potentially pausing if the data warrant it. And frankly, part of that is because the data have been good, right? Basically, since the Fed delivered that 50 basis point cut, you have seen, for the most part, economic data in the U.S. surprising to the top side. Maybe a one lone exception was the most recent non-farm payroll report, but the impact of striking workers and the timing of recent hurricanes in the South, as Powell mentioned, and as our economists believe as well, was a significant reason why that number missed so clearly to the downside. And so, part of that maybe a bit more cautious tone from Powell may just relate to the fact that the data we've seen in the last month and a half have generally surprised to the top side, which would be, regardless of who won the presidency, a reason for the Fed to maybe be a bit more open to the idea of pausing in December on its own. But certainly it feels like there was, it's hard to disentangle that from the election result and the potential for new fiscal stimulus and the potential for new tariffs. And, the Fed is in a very difficult position, Powell in a very difficult position. And I think after Tuesday, his job may have gotten even harder than it already was. So Imogen, let me turn to you now, and we'll talk a little bit about your side of the Atlantic, and specifically the Bank of England, because they also had a decision this week And, I think as expected, but certainly interesting in terms of the market reaction. So why don't you take us through some of your thoughts on what the BOE decided and how the market reacted to it?
Yeah, the decision itself was very much as expected, as you say. We and everybody else thought that they would cut 25 basis points, which is exactly what they did. A couple of things that were a bit more unexpected, that lean in different directions when we think about whether this was a dovish or a hawkish meeting. So the vote itself showed that 8 members voted for a rate cut. That means that only Catherine Mann, the well-known hawk on the committee, didn't. But more importantly, it also means that Megan Green and Hugh Pill voted for a rate cut for the first time. That gives the overall cut, I think, a bit more of a dovish feel. We had been sure that probably Green wasn't going to vote for a cut, and we weren't really sure whether Hugh Pill would or not. So I think that gave the sense that it was a bit of a dovish cut than markets had been looking for. Against that, though, we had thought that the Bank of England actually wouldn't really fully have incorporated the impacts of the budget announcements just a week prior into their updated projections. But they actually gave us more information than we were expecting. And they revised up their near-term inflation targets and their near-term growth projections. So they have inflation, or they have the impact of the budget adding about 0.5 percentage point to inflation at the peak over the next couple of years. And they had it adding about 0.75 percentage point to growth over the next couple of years. So the important thing to note here is that was actually a more hawkish, if you like, a more inflationary assessment of what the budget might mean than the OBR themselves had, which already assessed the budget to have quite, at least in the near term, to have upward implications to inflation. So on the face of it, you would think that all else equal, that would mean that the bank had judged that, the fiscal stimulus that was announced at the budget would necessitate a higher policy rate over the forecast period than they had previously thought, given that they'd had this upward revision to their inflation projections. But actually what we heard in the press conference was a little bit different to that. Governor Bailey, he was pushed quite hard by journalists, to be fair, to get a bit of a soundbite about, what the impact of the budget was on bank rate. And he stood his ground and essentially said that it wouldn't be sensible to conclude necessarily that the budget had an upward impact on bank rate, or would have an upward, impact, all else equal, on what bank rate would have been had that fiscal stimulus not have been announced. My take on that is more that Bailey didn't want to get backed into a corner in terms of, the headlines the next day suggesting that Bailey had said that Chancellor Reeves's decisions were inflationary, because really when you look at the meat of the forecast, when we look at the detail, we can see that the Bank of England has judged that the fiscal stimulus that was announced in the budget is going to have an upward revision to their inflation projections. And so in terms of how we think about the Bank of England going forward, it hasn't really changed our base case view. We always thought it was quite unlikely that they would cut in December. Markets agree. I think markets price in about a 25% chance of a cut in December. And there was nothing about yesterday's meeting that would really change our mind on that. But even beyond there, we still hold this view that terminal rate will be at 4%. That was always slightly higher than what most other analysts or economists in the city seemed to be expecting. And it was higher than what the market was pricing in. But as we've kind of spoken about on this podcast quite a few times over the few weeks leading up to the budget, we had already penciled in a bit of a bigger fiscal stimulus than I think most were expecting. In the end, that fiscal stimulus that was delivered was even greater than we had been looking for. So I think it's fair to say that we view the risks to that 4% number as being skewed to the upside, or at least I think you reach 4% at a later point in 2025 than what we are expecting. Markets have moved quite a long way over the last couple of weeks, and they are actually now more hawkish than we are, which is the first time in a long time. They have bank rate getting down only to about 4.25% by May, and they do see it falling to 4%, but not until later in the year. But I think we still probably remain at the more hawkish end of most economists and most analysts' projections. So I wouldn't push back particularly heavily on market pricing here, but I would probably flag that it feels difficult to see a scenario in which the market prices in a materially higher sort of terminal rate or a materially more hawkish near-term policy path. I think you would have to be expecting, big upside surprises on inflation, for example, for that to come true, which obviously, by virtue of the fact of it being a surprise, would not be in our base case projection.
Yeah, so I want to talk a little bit about some of these higher yields and what that means for the specifics of the budget, right? Because, there's a bit of, I guess, circularity in a lot of this, right? Which is that there's headroom in the budget that is dependent on, a lot of things, but one of the things is interest rates, right? And that, you've not only seen higher interest rates in the UK because of domestic factors, but now you've added in this Trump piece as well, where interest rates globally have gone up thanks to, what's gone on here in the US. And so what I think about here is that headroom is already limited. And with higher rates now and the possibility of having to finance additional deficits at even higher levels, is that something that reduces headroom even further? And is it something that you worry about that suggests maybe a higher likelihood of, say, a potential policy U-turn in the future?
Yeah, I think a lot of people have been thinking about this week, particularly through the lens that you say, Brian, is this going to be a trigger for a policy U-turn? And actually, where you might usually think of those kind of yield movements, the movement in bank rate and front-end pricing as being a negative for borrowing, i.e. higher debt servicing costs adding to the future borrowing pile, does it actually have the opposite effect in that it wipes out all of that headroom, and therefore it prompts a kind of downward revision to borrowing because the government has to announce, spending cuts and does sort of have to U-turn on some of its recent policy announcements. I guess at the extreme, that is a true scenario that could happen. Yields could rise far enough that all of that headroom is wiped out, and it does prompt some revisions to some of those spending measures that from the government in the coming months or years. But I would just highlight that we are still quite far away from the level at which debt servicing costs fully wipe out that headroom, even though it was only small to begin with. The OBR in their October forecast pack that they published alongside the budget announcements, they judged that it would have to take a 1.3 percentage point rise both in bank rate and gilt yields in every year of the forecast horizon for that kind of fiscal headroom to be wiped out, which is quite a bearish outlook for gilts. Even for someone who's naturally quite bearish gilts, that feels like a hard sort of base case to have, I suppose. And the other important point is that when we think about the fiscal headroom currently, that fiscal headroom is defined on the change in the fiscal space in year 4 and in year 5 of the forecast. So it's almost a little bit irrelevant what happens to gilt yields now. It only really matters what happens to how that influenced projections at the 4th and 5th year of the forecast. And so the gilt yields can sustain much higher levels, in the very near term without that necessarily having a huge knock-on effect for what that might mean for headroom at the 4th and 5th year of the horizon. And perhaps the other point I would make just on that is not that I think that this is anywhere near to what the kind of central scenario is right now. But even if the government were to be, getting worried when they look at the market, as you say, we're kind of closing in on record yield levels. Gilt yields have only ever been higher in that post mini budget period. And it's not just been a UK specific issue, they've also been influenced by global factors. But even if the government was looking at what's happening in the UK and thinking, okay, these yields are getting a little bit too high for comfort now, maybe we do need to pare back some of these spending increases. Any cuts to spending are more likely to come at the back end of the forecast period. That's likely to be in that 4th and 5th year, precisely because that's when, that's when the fiscal headroom is measured, but also because it's a rolling forecast period, and you can sort of promise what you like in 4 or 5 years' time. Who knows if they will even still be in power then? And so it doesn't imply at all, I don't think, downside risks to borrowing in the next couple of years. So for anyone that was thinking that the recent rise in gilt yields might actually be a sort of bullish influence eventually, I think that it's worth remembering those caveats that I've just been through. And actually, I don't see any near-term downside risks to borrowing. I think at this point as well, you mentioned, Brian, the fact that, there's kind of global concerns everywhere. And, obviously you've talked in detail about fiscal stimulus in the US and what that might mean for the size of the deficit. I think it's worth pointing out at this point that although this sort of, ballooning deficits everywhere, a very high supply, that's very much a global phenomenon. There's no denying that. But it's right that gilt yields have reacted in the way that they have, I think, to the budget announcements that we've had over the last couple of weeks, because the fiscal problem is sort of uniquely bad in the UK, if you like. And we've talked about this a lot before on the podcast, but when we look at the updated supply projections for next year compared to what they were in that pre-COVID period, for the US, we're still talking about only, which I know feels like a silly thing to say, but only a doubling in net supply, net of quantitative easing or quantitative tightening relative to that pre-COVID period, 2015 to 2019. In the UK, we're talking about it being 7 times larger. And so although the numbers are absolutely bigger in the US in terms of, overall borrowing needs, issuance to the market, the size of the deficit, I think it's worth remembering that relative to the size of the market, it's a big step change in the UK. And I was doing a bit of digging this morning on these interest expense numbers and how much this might be biting for the government. And when we compare the UK, interest expense every year is about 4% in the UK, 4% of GDP, which is higher than it is in the US, currently about 3%, projected to rise a little bit over the next couple of years. So despite the fact that the US has much bigger deficit numbers, much bigger funding needs, those interest costs in the UK relative to the size of the economy are also larger. So yes, you can see that gilt yields have risen a lot compared to what we've seen on, in totality over the last couple of months in the US and the Euro area. But I think that has been the right direction of travel, and there could be further to go, because I don't think that these rising yields present ultimately a kind of downside risk to borrowing needs. But that's enough on the UK. We were definitely a sideshow this week. So let's stop there. Thank you very much, Brian, for joining me on this joined up episode of Currency Exchange and Bondcast. Thank you to our listeners for listening in. And just a reminder, if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available.